A very warm welcome to everyone. Thank you, each one of you, for joining us for today's webinar. My name is Aditya Kachru, and I head advisory at Wealthzi.com. As the today's topic goes, why we are ultimately optimistic and uncertain amidst of certainty. So today's dilemma we want to address of the investors in most because a post-vaccine scenario, what we are coming across is the overvalued stock market. This is the question in every investor's mind. Second question is growth of the economy and the GDP, what it is reflecting as on today. It's again a question mark which is coming to our mind. Looking for the right time to re-enter, because last 1 year a lot of people have moved out. They want to come back. So is it the right time? That is the question. Should we stay back because we have invested over these years? Now is it time to have some portion of and stay for a pause for some period of time? And we have a lot of questions like these to be addressed. So so these are all genuine questions. So we at Wealthzi's thought to why not to address this in a proper professional manner. So Wealthzi thought to address these, and so we want to bring in somebody, some expert who is from the industry and have seen these phases day in day out, and they struggle, they take struggles day in day out. So they are the best people to give you a right picture and in a transparent manner. So well, here we are. We have our guest today, Mr. Aman Chauhan from Abacus Investment Managers, where he runs along with Mr. Sunil Singhania two portfolio strategies in mid and small and multi-cap with super stellar performance before start of COVID also. And midst of these COVID times, it's one of that in a century we find these times that much volatility that you can't even imagine. And in those volatile times, you find some portfolios finding navigate in those times beautifully. So they Abacus is one of those, and that Aman Chauhan and Sunil Singhania both together have created an history in terms of working with Reliance Asset Management also, and erstwhile Reliance Asset Management, and they delivered phenomenal returns over there, and taken that AMC as well new heights. So here we will I'll just give you one small brief. If we talk about their own performance of the funds at Abacus. So in the last one, if I talk about running FY21 figures, Abacus runs one strategy, Abacus Emerging Opportunity Fund 1. That strategy has delivered against a BSE 500 benchmark 40% excess returns over the small and mid caps category. And in the multi-cap category, in BSE 200 benchmark, they have delivered 30% additional returns to that benchmark. So this calls for an applaud also, and this calls for a tag of a star super performer. So which make them one of that fund managers in India. So just a few lines. I will not waste much of your time on Aman's background. Aman has 18 years of experience managing Indian equity. Prior to joining Abacus, about 3 years back, he had spent 14 good years with erstwhile Reliance Asset Management. Having worked at Singapore office at Reliance, Aman brings along a regional and global perspective. So it will be very useful for us today's, when he will be sharing us all his ideas and his views over the market. And along with Sunil Singhania, who was erstwhile CIO of then Reliance Asset Management. So that's a big, big expertise which what they are coming up with. So any, without wasting time, valuing the time of attendees, any questions, if any attendees have, please drop your questions on the chat boxes. We'll take during the course of the webinar as well, and at the end also. So thank you once again. Thank you everyone for sparing time for us. Aman, this is to you.
Sure. Thank you, Aditya, and good afternoon, everyone. Thanks for taking the time out for joining us for this market update session with us. And I believe Aditya has already briefed you about what Abacus is and what we currently do at Abacus. I'll just take a few minutes to share some other highlights, and then we can directly go to the market outlook. As many of us would be broadly aware, this fund was formed almost 3 years back. It was founded by a gentleman called Sunil Singhania, who was earlier the CIO at Reliance. Sunil quit Reliance to start this new entrepreneurship for himself. And I was also with Reliance at the same time, having worked with him for 14 years. There was a natural comfort between us. And I also moved on along with him. And we are the first two investment professionals at Abacus. Today, the team is close to 20 people, 12 people on the investment side, after which I and Sunil are from Reliance, the others are from various other market, both from buy as well as sell side. Almost 2 years back, we launched our maiden fund, which was Abacus Growth Fund. This was a multi-cap fund. And a year back, we had our mid and small cap strategy in the name of Abacus Opportunities Fund. We'll go through those details later. I believe the agenda today is more on the markets, on the current outlook, and let's right away focus on that. Sitting in Jan, if somebody were told me that this is what 2020 is going to be, it would be shocking and surprising the way markets have behaved. We had a phenomenal year last year, from the depths of despair in the months of March and April when the pandemic surprise hit us, to the months of June, July, August, September, where the markets globally across the board, things started moving up. And initially, we were all in surprise as to what's going on. Why is there a big disconnect with the economic reality? Pandemic is still on, lockdowns are still on, the debt rates are rising, but markets along with that also kept on rising. So we'll go through all those details as to why, what has happened. What I'm sharing on the screen right now with the summary that we are going to go through, and let's start the conversation. In retrospect, the calendar year 20 has been a roller coaster ride. Uh, we are sitting on the backs of decent gains in the month of Jan and Feb. The budget hit us, and broadly, that's where the markets peaked out. It was a decent budget to say so, nothing path-breaking as such, but with the constraints the government had, they did a decent job of handling both the fiscal deficit as well as getting in the reform as much as they could. Post that, obviously, the March surprise hit in when the COVID pandemic spread and there were global lockdowns. What that meant was that one, there was demand destruction. Second, there was fear. There was fear of what lies ahead, how things or how worse can things get. And obviously, we all know markets don't like uncertainty. Markets also have a behavior of overshooting itself, both on the upside as well as on the downside. So it is never normal range for a market. Either it is on overshooting on the up or overshooting on the down. That exactly happened in the month of April when the market undershot itself. From a high of 12,000 Nifty, it hit a low of 7,500. And then we felt, even in spite of uncertainty, it was broadly an undershoot with the market did. Aditya, can you mute everyone besides me? Yeah, so sorry. March and April was something which is a shock and surprise to us, and it took time to understand as to what is the gravity of the situation. These were the months where we were reshuffling the portfolios. We were looking at which companies would survive this pandemic, which companies can benefit, which companies will see a maximum impact. At the same time, the time frame was uncertain to us as to how long this is going to continue, uh, when can be the medical remedy to this, and that was the period of uncertainty. For us in the funds, we were sitting on cash. We were gradually deploying this cash, but frankly, we were not aggressive because in hindsight, it looks like it was a sector opportunity. But at that point of time, when in the midst of action and when you don't know as to how things will pan out, whether the fear was that it can get worse. So what you saw was, well, the current situation. You can analyze the current situation, but when the fear is that it can get worse, and you exactly don't know how worse it can get, That is what the uncertainty is, and that is what markets don't like, or rather, no asset class or no investor or none of us would like to have be into that situation of uncertainty. June, July, August, September, the market started to move up. Initially, it was a period of disbelief. Then people realized that it's the liquidity which is driving these markets.
Oh,
Practically, practically speaking, what takes markets up? The companies are the same. The companies that we invest, they don't change on a daily basis, but the stock price changes on a daily basis. Every minute, the stock price changes. Why is that? There are two functions in market that works. One is fundamentals, which is the earnings of the company, and the second is the sentiment or the P, as we say. So EPS is fundamentals, P is what the sentiment is, and what drives the sentiment? Liquidity. Liquidity drives this sentiment, and that is what eventually happened in 2020. After the financial crisis of 2007, never before have we seen this kind of unprecedented stimulus being announced globally. What we saw in India was nothing. We just announced stimulus which was less than even 5% of our GDP. But what happened in US and what happened in Europe was something which is unprecedented. I'll If you see this slide here, this is showing the kind of money supply the world has seen in the last few months. Never before in the history have we seen this kind of a jump. Even during the financial crisis of 7, 8, we have not seen this kind of unprecedented money supply coming in. And this money supply came in from everywhere: US, Europe, central banks, Japanese banks, China, you name it, and all central banks were doing this stimulus. And why was this required? It was required because there was no demand. There was demand restriction due to lockdown, and you had to. This was a classic Keynesian economic theory that you reflate the demand, and this is what happened. Now, this is very commonly said between us that it was liquidity that drove the market. It is liquidity that drove market. There's also one more point, which is not just liquidity, but even the cost of liquidity. As we see today, the cost of borrowings globally is hardly 1 or 2%, even if you want to borrow for 10 years. If you're a large corporate, you can borrow at 10-year paper at less than 1%. And if you're an individual, it would still be below 2%. In India, not just mortgage rates at today at historic lows, even otherwise, all other loans today would be at decade low rates. The cost of liquidity also has been pretty low. So if an investor can borrow at 1%, or if an individual can borrow at 2%, even if he gets a dividend yield of 3 or a return of 4% anywhere, he's more than happy. So that compressed the return expectation across asset classes. So this liquidity not just impacted equity markets, it impacted everything across the board. All asset classes moved up, and this is what eventually the performance was. It is not just India that Indian equities today are at a high and we have done well. We have done well, but in relative terms, we are as good or as bad as anybody else would be. So the MSCI World Index last year was up 11%. The MSCI Emerging Markets was up 13%. Across the board, equity markets were up. Few markets like UK and France were still in the negative because they had the second wave, and the recovery there was pretty slow. But bearing that, most of the equity markets today are at the highs. And not just markets, even currencies and even commodities. And within commodities, it's both oil, precious metals. Silver was up 34%, gold was up 20%. And you see, there's a saying, a rising tide lifts all boat. And that is exactly what happened in the past 9 months. The liquidity tsunami that we saw picked up all asset classes with it. So if you see in isolation, we'll see that yeah, India is at a new high. But if you see around us, everything is at a high, everything has gone up, everything has moved up. And exactly is the point that it is a common factor of liquidity and the low cost of liquidity that has led to this. Now, obviously, the question would be now what? That's we have understood it, we have realized it in hindsight. We know that it is liquidity which is driving this market. But the key question to is, as an investor, now what? Either we are already invested or we're looking to invest. and then what's the outlook beyond what we are seeing today. So clearly on the medical front, things are much, much better than what it was. In spite of the fear of a new virus strain, today there are not just handful of companies that already got approvals. The first dispatches is already in. Europe is already seeing vaccination drive going on. In fact, it has even started in India. So the medical response has been very swift and very rapid, not just in getting the dosage in place, getting the approval, but also into manufacturing and distribution that. So from the medical strong point of view, we feel that worst is behind us. Even if there is a second wave, the chances of it being very more destructive or more severe than the first one looks remote. And will it lead to something which we are not prepared for? Also looks remote, because now we are prepared for. Let's think of this as a very simple thing, that when the first lockdown happened, there were few thousand deaths. We have seen 10 times more deaths than that few months back. And even today, the count of deaths is higher than when the lockdown started. But today the lockdown is off. Why? Because it's no longer a surprise to us. We know how to behave, we know how to handle it. And that is where the situation is. If something goes wrong, now we know how to handle it. Now we can act, and there's less of fear today. And that is the reason the lockdown is up. It is not just the deaths, it's how to handle it, how to handle the fear, how to handle the uncertainty. So today we have much more knowledge about the virus. We have much more understanding as to how to handle it. And for that reason, we feel that the medical risk is broadly behind us.
One second, Aman, your voice is a little slow, coming very low. So one of the participant I have just gave the feedback.
Sure. Is it better now?
Yeah, it is better.
Yeah. Second thing is this liquidity. Now we all know the central banks have been pushing on this liquidity. What is the outlook here? So outlook here is pretty simple. Almost all central banks have said that the intent is to keep this liquidity on. The intent is very clear that they expect interest rates to remain low, because demand is not yet picked up. They are not that much worried about inflation. So today the priority is to reflate the economy than to worry about inflation. Hence, they have all committed the liquidity is here, at least in the near term. And the near term is few years according to them. So it's not that they are looking at once demand picks up, immediately they will withdraw the liquidity. They will withdraw it in a slow, gradual manner. We have seen this happening post 08 crisis. Between the period of 12 to 15, central banks did the QE, which used to happen in that point of time. They gradually withdrew it, and there was no impact on the markets. Same thing is being committed this time around also, that this liquidity is going to stay for longer than what people expect, and even the cost of liquidity. Almost 30% of global bonds today trade at negative yields. That is the kind of liquidity, that is the kind of cost of liquidity impact that has happened. If you have a saver and if you're in a developed market, then this is one of the worst times for you, because you need to pay a bank to keep your deposits with it. So one of the worst periods for a saver, but if you're a consumer, you can't get a better period than this. So the outlook on liquidity remains positive. The third thing is the dollar. We all know dollar is the reserve currency, and whether there is a trade war with China or no, and whether China would definitely want to dominate the currency field also. But as we speak, dollar is de facto the global currency, and that stays. Now, what is happening is, because of this liquidity push, we are seeing dollar depreciating across all major currencies. This is driving valuations as well as liquidity flow into emerging markets and into other asset classes. So if you can borrow in a dollar, you invest into a currency which is different from the dollar, you make some returns. In during that period, the dollar is depreciated. When you convert it back, you made an extra return. So this is what is happening here. It's called a carry trade, and that is what is in force as we speak. Over the last 6 months, dollar has depreciated. The consensus view right now is that this will keep on depreciating. It is just not a 1 year phenomenon. If you see the chart to the right of it, it's a multi-year phenomenon. Dollar normally has a 10-year cycle. We are right now just in the beginning of the first year of this 10-year cycle where the dollar has to depreciate. My personal view is this depreciation will happen, but not with the same rapid speed as what consensus would be believing in. But yeah, the trend would be depreciating. The trend, I think, would be very similar to what INR is. If you see the INR is a depreciating currency because we have a higher interest rate and a higher inflation. But it's not a very smooth linear line. There are phases where INR has appreciated also or remained stable. So in spite of this dollar depreciation, 76 has moved to 73, but now we are stable at 73. We're not going down. There can be periods like this where the dollar would be stable, but the overall macro trend or the broad 10-year trend is that the dollar is depreciating, and this creates the dollar carry trade. This is a very powerful trade which happens globally across asset classes and something that one needs to be very mindful of. As I mentioned, it's not just the liquidity, but also the cost of liquidity. The chart on the left of you is the surplus liquidity India currently has. And obviously, we know that the T-bill, the 3-month T-bill is now below 4%, which is at a historic low, and the 6-month is below 6%. So, what has this things led to? This has led to the markets trading at the highs, and clearly the point that we now discuss is about valuations as to how long these markets can keep on rising. Yeah, definitely. From the lows of March, things have reflected. As we speak on a trailing basis, we are 30 plus as far as the Nifty is concerned. But trailing basis is not the right matrices because obviously it has the maximum impact of the 6 months of lockdown that we are seeing. One has to move beyond FY20, look into 21 and 22 now. 21, according to us, would be a normal year. There will be still some impact, but things will be much, much better than what it was in 20. 22 will be a full year where you also see growth. If you have to go beyond 20 and look at 23 basis, then yeah, we are trading at almost 18, 19 times FY23 earnings, which is near our 10-year average. Is this good or bad? No, there's nothing like that. We are at the average. Can we go up? Yeah, we can go up. Have historically we moved beyond the historic trend? Yeah, we have. Have we undershot it also? Yeah, we have undershot it also. Now it all depends as to how the market sentiment behave. From a valuation standpoint, we are no longer cheap, but at the same time, we are neither expensive also. We are near our 10-year average. And India is always traded at a premium to its peer group. And the premium is because it's a very diversified market, it's a very liquid market, and the ROE ROCs in India are at least 2x of that of the peer group, both in Asia as well as in European countries. So that is what drives the valuation in India. And hence, yeah, we are no longer cheap, but at the same time, uh, it's not that we need to be worried or scared about the valuation as we speak. If you want us to look at markets, besides the normal PE basis, in the market cap to GDP, it's still below 1. GDP, which is deflated right now. So we are expecting a double-digit GDP growth next year, but that is coming on a low base. Post that, a double-digit nominal GDP is something that is easily possible in India with the kind of demographics and the kind of macro positives that we have. So on a market cap to GDP basis, there's still scope to improve. And the most important thing, these valuations, we should not look just in isolation. Now, this has to be in related to the bonds. So today, if you go to a bank and have an FD, you'll get anywhere between 3 to 5%. If you are a bond mutual fund investor, the returns are something similar. It's a pre-tax. So the return expectations across the board, whether it is bonds or the other asset classes, have come out. So on a relative basis, equity is still not expensive. If you can borrow at 1%, you're even happy off if you get a dividend yield of 2%. This dividend yield of 2% 6 months back or 2 years back would seem very unattractive to you. But today, if you're not been able to generate even 1% return on a global bond market, then getting a 2% return on equity makes much more sense. So on a relative basis to bonds, both in India as well as in the US and in other markets, we are nowhere near the peaks. There's still lots of relative value which can come in, and this indirectly means that this equity P can keep on expanding. There's still scope for the equity P to expand if looked in terms of relative to the bonds. Our premium valuation, which I mentioned, that India always trades at the premium. The premium valuation that we are trading on is also within historic range. It is not that we have overshot the premium valuation, and that is also something which is comforting. So if you look at just pure P numbers, you might not find that kind of a comfort. But if you look at relative basis, and if you look at the peer group, then it's not. We are still in a very comfortable position. Now, coming to specifically the Indian markets, we know India is a very well diversified market, and there are specifically two sets of investors or two set of segments in the market, and they don't normally behave in a set pattern, and that is large caps and mid caps. In India, historically, mid cap investing has been a very different style than large cap investing. Large cap investing is something that we have, it's more linked to how the global flows are, and mid cap investing, I feel, is more linked to how the local sentiments are. Obviously, liquidity drives that sentiment, but the cycle that mid caps goes through is very different. So, as this rally spread during the year, what we saw was that the rally has now broadened. Uh, Mid caps have started to participate. In fact, 2020 was the first year after a gap of 3 years where they again outperformed. Prior to that, they had outperformed during the 16-17 period. Going ahead, we expect this trend to continue. We expect mid cap rally or mid cap outperformance to continue for a simple reason that of a low base, they would report a better growth number than a large cap, and the valuations here are still at a significant discount to the larger names that we have or the benchmark valuation that the market trades at. One needs to be very careful here because not all mid caps will be able to survive this pandemic. There will be many companies that will be at the receiving end where the balance sheet would have gone broken and they won't be able to survive. So one needs to be mindful of that. There will be many business models that would have changed. Having said that, if one is focused on which sectors will see improvement, which sectors will benefit, then clearly there's lots of opportunities in the broader market here. This is on the economic activity. We all know things have moved on, except for the few metros that are still seeing some kinds of lockdown activity. Things are almost back to normal. In fact, in many areas like GST and PMI and e-bill collections and everything, we are now above the pre-COVID levels, and that's a very healthy and a good sign. From the government side, also there will be lots of initiatives to better manage the country, and they have taken lots of significant reforms, which both in the short term as well as the long term going to have significant benefits, and this eventually is going to get reflected in the GDP growth rates. So we have seen growth is decelerating. We expect that trend to reverse, and we now feel that GDP can start accelerating from FY23 onwards. 22 from a low base obviously will look high, but beyond that, also we expect that GDP can definitely accelerate because the Make in India initiatives, the PLI initiatives, the fiscal management, the record high forex reserves that we have, the stable currency, and the low interest rates. It's a combination of all these things that makes us feel that GDP in India can definitely accelerate. So broadly, what's the broad call now on the markets? Clearly, we are at a new high, and from here on, getting the same kind of returns would be difficult. So instead of giving you round and round talk as to yeah things look good, but be cautiously optimistic, it's better I be very clear and upfront with you. And the clear upfront call here is that we are positive. At the same time, higher valuation means you have to lower your return expectations. People have made 30, 40, 50% return in the last 6 months. 1 year returns has been in a very different, it has been quite high. And post this sharp rally, if somebody is looking to invest fresh in this market, then the return expectations has to be low. What we feel is that over the 3 to 5 year period, you can still make a healthy double digit earnings CAGR both in large caps as well as in mid caps. In mid caps, this can be in excess of 15% plus. In large caps, this can be anywhere between 10 to 15%. And that to us is still a very healthy number. I'm saying this on a 3 to 5 year basis, not an immediate 3 to 6 month basis, because we don't know what markets will be in next 3 to 6 months. In the near term, after having such a sharp rally where indexes have almost doubled in less than 9 months, there can be bouts of correction, there can be time correction, there can be swift 5-10% move in the markets. And I would say that will be healthy. But is it possible? Yeah, it's definitely possible. But one needs to be scared of that? No. But we feel that one needs to accept that the volatility is going to stay. Equity markets means that it's going to be volatile. But volatile doesn't mean it is risky. That's the nature of this market, that's the behavior of this market. If you're disciplined and if you're clear that you need to benefit out of this volatility, then volatility is your friend. It gives you lots of opportunities. As I mentioned, equity markets overshoot both on the up as well as down. So be prepared, be clear as to what you're getting into. If that clarity is there and if you're able to execute the way you have thought it, then volatility is your friend. Benefit out of it. So overall, in spite of having a lower return expectation from year going on, I still feel that equities will give one of the best asset classes to invest into. And on a risk reward equation, it still makes sense to stay invested in equities. When in investing, you're obviously positive in markets. Otherwise, why would you invest, right? We all invest for returns. We all invest for the wealth to grow. So you're already taking a stand that you're positive, that you're positive on the company, you're positive on the markets. If you are, stay positive. That's the message I would say. But at the same time, be prepared for volatility. Don't run away from it. Accept it as is part of the market behavior and grow with the tide. Clearly, there is some risk in the market and which we are mindful of, and we would like to highlight that to you. One is this liquidity which is driving this market. There is a near consensus view, and the consensus view is also coming from the statement of the central banks themselves that this liquidity will stay for long. We all know consensus views don't work, but in the near term they do. And that is what we are right now in. It's a consensus view that liquidity will stay. It is staying as of now, and we feel that should continue, but one should be mindful of this. If you see US market or this is liquidity, post the financial crisis of 2008, it's been almost 12 years non-stop. Equity markets globally have given you a positive return, or the US markets have given positive return for 12 years. This liquidity has stayed on. There have been rounds of more QE or less QE, but the liquidity has stayed for long, and that has helped the markets. So it's very difficult to say that now it's been 2 years of bull market, now there should be a bear market, or now it's enough. It's been 5 years, it's been 3 years. We don't know. This can go on for longer than what we expect, as we have already experienced it between the phase of 2008 to 2020. Liquidity has stayed on, and markets also bearing a few bounds of volatility as continue to deliver positive returns. Clearly, this liquidity will also eventually lead to inflation. If it's cheap liquidity, it's going to create demand, and this is what central banks are looking forward to. And there can be near-term inflation risks creeping in. No central bank will tell you that if inflation hits in, we're still going to maintain this liquidity. So if the inflation goes out of control, they will have to act. They will, and I think the market is prepared for that. There can inflation, according to me, is not going to be uh, that severe that central banks need to reverse the liquidity this time. There can be easing of liquidity. There can be few rounds of interest rates hike also, but that is still some few years away. For the next 2-3 years at least, we feel this low interest rate scenario should continue. The rising commodity prices across the board will have an impact on earnings. One needs to be very mindful of that. Specifically, December quarter earnings for Indian companies are going to be good, but clearly this margin impact will be visible in the March quarter onwards. So that's what one needs to be mindful of. Second wave of emergency can surprise us. Right now, the feeling is that we are well in control, but who knows? And there can be re-emergence on the global political or the trade front. There is a change of guard in US, but at the same time, the economic reality has not changed. The fiscal deficit or the trade deficit between US and China continues to go up. The absolute value of imports US is doing from China is still on a high. It's still rising. So in spite of the trade and the currency war, US continues to import more and more stuff from China than what it used to do before. So this continues, and obviously this will be a red flag going ahead, and there will be some points of discussions or some action on this front. So these are the risks one needs to be mindful of, and which today looks evenly balanced out. Nothing looks like very shocking or very serious in the near term, but definitely needs to be mindful of the risk that one is carrying in the markets right now. So that's broadly on the markets. That's broadly on the view that we have. Now, the key and critical question is that this is the market view. How do you invest, or how do you use this return risk reward equation into your, sorry, how do you use this risk reward matrices in your investing? So for us, investing in Abacus is very simple. This is a boutique fund house. We are not here to build size and scale as the only focus for us. We have a different philosophy from a large corporate investment house, and that is that we are alpha generators. So we are not asset allocators. We will not invest just for the sake of it. We don't invest in a underweight or a overweight basis that certain sectors is underweight, certain sectors is overweight, and we are happy that if we are able to deliver few bips more than the market, then my job is done. No, so we are alpha generators. Anything that we invest into, the idea is to generate positive return over a 2 to 3 year period. We do only fundamental investing, no technicals, no derivatives, no intraday trades, no short-term trades, no news flow, no momentum, nothing. Pure bottoms-up, research-driven, fundamental approach towards investing. And for that reason, we have another larger research and investment team in the industry. We have a very independent thought process. So we are not consensus believers. We do primary research. Most of the companies that we have invested, at least half of the portfolio companies, there will be no market coverage. So while we do get market support, but half of the portfolio is companies that market is not tracking, and it is our primary research that has led to the conviction in them. We are agile, we are flexible, which I believe is a requirement. It's not a choice anymore in these markets. We're happy to be contrarian. We are patient investors. We invest with a 2 to 3 year view. And for us, anything that we do, the risk equation is the primary focus that we have. There are various strategies in the market. There are almost 40 AMCs, and there will be hundreds of schemes and different strategies in the market. Everybody has their own benefits, everybody has their own positives. For us, we believe we should do what we are good at, and we feel we are good at investing in a value conscious way. So in our portfolios, you will see that across the investment names, there will always be some value consciousness. We are shy to pay a very high premium for growth. That doesn't mean that we are only value focused, or you will see only cheap stocks or single PE stocks. No, it's not that the case. But if the company is good, the company is growing, definitely it will command a premium. And we are ready to pay that premium, just that the premium should be reasonable. So we don't chase quality, or we just don't chase growth at any price. So that's a very big difference that we have versus some other strategies. Nothing wrong with that, just that we are more comfortable in this. We believe that not just the company has to be good, but even the investment has to be good. So a great company need not necessarily always be a great investment. For us, that focus always stays. And how do we do that? It's very simple. We have built up a framework for investing, and we follow this framework across all our schemes, and we call it the MEETS framework. Very quickly, what MEETS stands for? M stands for management, management quality, capital allocation, corporate governance, history, how have they been into the business for how long. All these things come into management. Ultimately, when you're investing into the management. The company is an output of the management. We always have this discussion: is a good management, bad management? What is that? It's the quality, it's the drive. India is the land of entrepreneurs. We thrive on entrepreneurs, and that has always been our focus. Earnings is very important to us. We all like to buy cheap. We all like to be value conscious. We all want to have value stocks. But value without any trigger or any growth remains value or becomes deep value. This is our understanding of 20 years of mid cap and small cap investing in India over multiple cycles. Pure value doesn't work. Earnings have to be there, and that is what our focus is. We will not invest in a company if there is no earnings growth. And that is also one of the biggest reasons why we have outperformed over the last 2 years. Earnings has been a prime driver for our performance. In the quarter of June, which saw the maximum impact of lockdown, to the September quarter, to the forthcoming December quarter. In all these quarters, the portfolio had a positive double-digit earnings growth. In spite of the lockdown, in spite of the uncertainty, in spite of the demand destruction, one thing was very clear. We had double-digit plus earnings growth across all our portfolios. And that to us is one of the biggest reasons for our performance. The second E stands for events and trends. There are always some trends in the market. There is always some M&A activity. There is always some opportunities which is there in the horizon, new themes coming up, and we focus on that. Timing is very important. By timing, I don't mean as to which day or which time, which level I invest in the market. The timing means to at during the growth cycle of a company or during the investment cycle of a company, what is the right appropriate time to look at? A company is a company. If it's got into capex mode, it will happen for the next 2 3 years. The company won't perform because it's spending. At the same time, it is getting out of the capex mode. It's going to be very attractive investment opportunity for us because there's going to be both financial leverage kicking in as well as operational leverage kicking in. So there are always some triggers in any company, and your timing plays a very big role. It also helps in determining as to what time price levels you want to invest at what valuations you want to invest. So that is something which is very critical. As I mentioned, we don't want to pay unnecessary premium in the market. So we try to see as to what is the life cycle of this company, what is our investment horizon, and we would like to get the timing dimension correct in most of the investments that we do. And the last is S, which is structural. There are lots of opportunities in the market which are structural. Consumer companies, B2C companies. Right now, internet is the theme, digital is the theme. These are into multi-year demand expansion segments. These are companies, these are sectors which are directly, steadily, and consistently benefiting from the macro positives of the company, and it will continue to do so. So one needs to bank on the structural positives and capitalize on that, which we do in the fifth event. So that's our meet framework. We follow this across all our schemes. This is our investment process, which I would not dwell much time on. And this is what I would definitely like to highlight. So one was earnings growth, which I mentioned, and the second was valuations. We don't pay a very high premium. So this is the earnings growth of this portfolio. For the June quarter, Nifty had minus 31% earnings degrowth, but our portfolios had anywhere between 20 to 35% earnings growth. For the September quarter, Nifty was positive 17, but we were anywhere between 25 to 70. So that's the kind of earnings alpha that we have in this portfolio. And to us, that's one of the key reasons for the performance which has got delivered. And we hope to maintain this going ahead also. The new investments that we are doing is also keeping the same thing in focus, that earnings growth should be strong. That's broadly the track record. I'll not spend much of the time on this. My colleagues have already discussed this. This is the growth fund. This is the multi-cap fund that we have. And the second one is the mid and the small cap strategy, which is now 1 year plus of track record. This is the PMS that we just started a few weeks back. It's still very early days, and it's basically a replica of the two strategies that we have in the AS. So one is a multi-cap strategy and one is a mid and a small cap strategy. So that's broadly the presentation from my side. I'm sure that you will be having queries, you will be having lots of doubts, both with regards to market, with regards to our strategy. Happy to be of help to you. Feel free to ask any doubts, anything that you have on abacus, on markets, on funds, global markets, anything that's bothering you.
Yeah, thank you, Aman. Thank you, Aman, taking us and attendees with all that insight. And you have been very much transparent and sharing your all last year's work and how you approach to equity market. Plus, our concerns more largely, I believe you have addressed it. There is a lot of you mentioned that slide where all that risks while investing is there, but to summarize all your slide and some positivity to give it to our attendees. Overall, when we look up to that, what I got from Aman's slide is that India, and if you look at the domestic environment, we are about approx 600 billion forex all-time high. So that is one of the all-time high. So this is the biggest positive what India have right now. Interest rate as of now, it's one of the lowest in the decade. I don't know when I have seen in my years. I have never seen the interest rates at home loan interest rate. In fact, at 6.75 or a 7%. So I have never seen those rates in my entire career. So and the dollar rate today, it is more far stable than last 5 years. Transmission of interest rates from RBI to banks, it has been phenomenal in the last 1 year, which was never seen before. Risk of inflation, yes, but it's stable still. It's still low and highly expected is to remain low, but you never know. Overall housing market, except Delhi NCR, there is real estate is start picking up in the lower level segment just because of lower interest rate. So yes, valuations looks somewhere looks frothy, but overall there's a lot of positive. Volatility will remain here, no doubt. But perspective, at least what I feel is that Aman is very clear. Today's number will be volatile. There would be a time, there would be some correction. Maybe then new highs we will see. But 2 years would be the highly volatile. I open this floor for the questions. There are few attendees have parked some questions over here in our chat box. So Aman, for you, this is from Kapil sir. This question is FII based rally will last long? Is it close to reality? And if correction possible, how much dip percentage is expected?
The low interest scenario is here to stay. And as I mentioned, that the dollar environment of the depreciating dollar looks to be a 10-year trend at least. If that plays out, then the FI flows into emerging markets, including India, will continue to remain strong. If you can borrow at 1 or 2%, even if they make 3-4% in India or in emerging markets, they would invest, and plus they will be having currency gain. So yes, we expect this FI trend to continue. If you see, ever since the FI started investing, there have been only 2 years where they have taken money out, and those were the crisis years of 07, 08 types, right? Otherwise, even in not so good years, even in bad years, FI flow to India has been positive, and we expect this trend to continue.
Yeah. Sir, there is one more question. What will be interest rate scenario in next 2 to 3 years in view of excess liquidity now, and whether liquidity continue to be high?
So what will happen is, the first step would be over the next, say, 6 to 12 months, the fresh liquidity infusion will start to reduce. There will be certain rounds and there will be certain measures to suck the excess liquidity out of the system.
Yeah.
Post that, there will be gradual increase in interest rates. I'll say gradual and subject to how the economic situation is. Otherwise, we see that the liquidity scenario, the surplus liquidity will get out of the system, but the interest rates will stay low. From a 0.5% or 1%, there can be a quarter or a 50 bips move upwards. But we are not expecting any sharp interest rate hikes in the near term, not in India, not in the world. But yeah, this excess surplus liquidity which is in the system, that will gradually start to taper off once lockdown measures are taken off, vaccine distribution is done, people start living a normal life. Gradually, the surplus liquidity will be sucked out of the system by the central banks.
Yeah, makes sense. Do we see any major, it's from Mr. Bhadran, do we see any major market correction in the coming days? It's a common question. Yeah.
Yeah, difficult to time the market or difficult to answer this in the near term. It is common sense to believe that markets have rallied and have almost doubled in 9 months' time from a 7,500 Nifty to 1,400 today. And after such a ferocious and a sharp move, a 5 to 10% uh, correction is, I'll say, part of the game. It's like one shouldn't be scared of. So we don't see a major correction kind of a thing unless there's a Six Sigma event. There will be bouts of profit booking. There will be bouts of fear. There can be some news that can be like we are headed for the budget, right? There can be positives. There can be some disappointments for some sectors. Things like that will keep on happening,
True.
which will have a 5 to 10% move in individual stocks. But beyond that, we are not expecting any sharp correction in the markets.
Yeah. And so one, this is a reason for high liquidity, industrialization further seen, long-term view of interest. So we have just, just a while back we answered it. We'll go to the next question. So amongst the industries, which sector is poised for large growth?
So we have already seen pharma and tech sectors benefit out of the pandemic. Going ahead, the sectors which are levered are going to benefit the most out of this low liquidity scenario. So we have materials, metals, materials, industrials, the REITs, the infrastructure sector. These are the sectors which are going to benefit from this low interest scenario. So they are the sectors where there is maximum debt, there is a maximum cost of capital that comes in, the interest burden is high, and these sectors will benefit the most from this low interest rate scenario.
Yeah. Aman, there is a question from PV Sahed. He's our Wealthzi's founder. Will we see a prolonged correction or a short and swift correction and then come back to the current levels?
I would put my money into a short and swift.
Yeah. And is a potential big economic collapse in the US because of too much of currency printing a big risk to the Indian market as well, or will India be largely insulated?
We don't see risk of economic collapse in US. At the same time, India is not insulated. We might have only 2 or 3% of global trade. So in a way, it's a inward-looking economy and it's a domestic growth-driven economy. But at the same time, this growth is being funded by external capital. So every year we are seeing FI as well as FDI inflows coming in, and that has helped the 600 billions of forex buffer that we have. So while growth is internal, it is being funded externally. So if something goes wrong externally, the impact of that will be visible in India also. We will be in a much better shape than what other economies would be, but there will be an impact if something drastically or there is a economic crisis in the Western world.
Right. There is one question from Kapil Barochia. Do you invest through SIP in PMS or a lump sum? So actually, the client these days are actually looking for a staggered way of investing in through a
Yeah,
in a
frankly,
PMS. Yeah.
even we prefer that, and we have an option of both a direct as well as an SIP mode in PMS.
Yeah. So there is again, from our co-founder Pradeep Pillai. Shall I stay put in equity or book profit? Shall I enter slowly to market? So
Enter slowly would be the right will be the right approach according to me, and you should book profits wherever you see valuations become frothy, wherever you see growth is going to disappoint, wherever you see things are not as good as you would have expected it to be. So that should be a natural and a continuous process at your end to book profits from stocks which have already delivered or are not performing as per expectation and move the money into companies where you see the potential. So this should be a natural process of booking profits and reinvesting them. I think one should stay invested in equities uh, as an asset class, as I mentioned, on a risk reward basis and on a relative performance basis. I feel equities can deliver much better returns, because what is the alternatives that you have? As I mentioned, pre-tax, it's mid-single-digit returns in FDs and bonds. Real estate valuation, liquidity has improved, transactions have improved. Will it give you a good price appreciation? I don't know, because I think the supply is also equally strong. So it should stabilize here, then give you a very high return. Precious metals, yeah, we have seen a long period of no returns. Last year has been good. This can continue, but it's not something that will continue in a very for multiple years to come through, which equity markets can, because till the time there's earnings growth, your equity portfolio can keep on giving you a positive return. So from a relative as well as on an absolute basis, we feel equity as an asset class, one needs to stay invested and have an exposure.
Fair, Aman. There is one more question from Yogesh. Your fund house view on gold and oil, if any, if you keep and hold on other assets as well, other than equity. So.
Yeah, so we are not experts in either of them, and nor do we invest. And it's difficult for me to give you a view, because then that will be a shared borrowed view, which makes no sense. You can get that view on Google also by reading any of the report. One thing I can tell you that we do believe that dollar depreciation will be there. It will be gradual, but dollar is expected to depreciate. Maybe not to the extent of what consensus feels, but at least the trend should be there. And if this trend does come in, then it's good for commodities across both precious metals as well as other commodities.
Any guess any attendees, any questions coming to your mind, you can ask Aman. Any query related to investing or any queries other than some specific queries if you have regarding the equities. The floor is still open. Let's wait for an 15-20 seconds.
Sure.
Hi, Pradeep here. Just wanted to check in. What is your exit strategy as far as any of these stocks that you've picked up? It's very difficult to understand exit strategies in. If you can give.
Sure. It will sound simple, but the key lies in executing it. And the exit strategy for us is very simple. One is when we feel that the investment thesis or the reason for which we are invested is not going to pan out, you exit. Then you don't look at the price, you don't look how much money you're making or how much money you're losing. If your thesis is not working out, it's better to exit, bite the bullet and exit. And this can happen on both the fronts. Something goes wrong with the company, or the company is not being able to deliver as expectations, or there's some changes on the macro front. So it could be a combination of both. During pandemic, there are certain sectors which got impacted, for which we thought it's better to exit. Like for example, we have Shopper Stop in the portfolio. Clearly, post pandemic also, now we are not expecting that kind of consumer enthu on a brick and mortar retail the way we were thinking it earlier. Or we had paper stocks in the portfolio where we decided to exit and move the money somewhere else, because uh, there's going to be a demand impact on the kind of people that we consume, right? So these were macro trends which we uh, had to act upon, and we exited in loss. There have been times where the return has been pretty sharp. For example, we invest one of the first companies that we have invested was Muthoot Capital. Uh, Stock has done phenomenal well. It's a great business, India's largest gold loan financer. Stock is up 3x from our initial investment, and we felt stock has done well. Going ahead, it's better to move some of this cash into another name which can perform even better, and we book some profits. So it's a combination of both. When you feel that valuation is full or the stock has done much better than what your initial expectation was, you like to book profits. And when things go wrong, it could be for whatever reason, it could be even your call going on. For example, we have some stocks in the portfolio which have not performed. We have Sadbhav Infra which has not performed for us. There was a time when we took a loss in Ashok Leyland because the whole CV cycle got delayed than what we expected, and we had to book losses in those names. Uh, Nobody will be right all the times. There will always be some stocks or some ideas that have not worked. The idea is that uh, if you have a hit ratio of 70 to 80%, that is a very good ratio to succeed and generate alpha in markets, and that's where our focus is. So exit is a combination of both.
Aman, we have one question. In the new PMS which you are launching, what will be the focus sector and the market cap focus? And what overall, in the presentation, any critical point which you want to highlight of that PMS?
Sure. So we have two strategies in the PMS. One is an all cap portfolio where broadly 50 to 60% will be large caps, and the balance would be larger mid caps. There could be small exposure to small cap, but that is be like in single digits kind of thing. This is going to be a very stable portfolio. At the same time, it is going to be different from the normal large cap schemes that you see. So as things start today, we don't see we invest into HDFC Bank or the Hindustan Levers of the world in this portfolio. At the same time, if it's not HDFC Bank, it's going to be an ICICI Bank in the portfolio or a SBI into the portfolio. We might not have an Infosys in the portfolio, but there's going to be a Tech in the portfolio. So it's going to be a large cap focused portfolio. Need not necessarily the top 10 names that you commonly see across most large cap portfolios, because we don't do benchmark investing. We invest with a alpha focus in mind, and most of the stocks would be known to you. It will be a relatively stable portfolio, and the idea here would be to generate anywhere a good alpha over the benchmark market returns. So that is one strategy that we have. Uh, the mid cap year would be the larger mid caps, so market caps in excess of 10,000 crores, like names like Muthoot Finance, Polycab, Crompton. So this will be some of the portfolio names that we have right now, and that is where the focus would be. In the other strategy, we will be focusing on mid and small caps. Here, we would be say 60 to 70% mid caps and 20 to 30% small cap exposure. Here, the investment horizon is pretty vast. We will be investing right from 1,000 crores market cap all the way up to 30,000 crores market cap. So it's a much broader canvas that we have here. Uh, in mid and small cap investing, you will see less of financial sector exposure versus a large cap, because most of the financial companies are in the large cap bracket. So that is going to be one sector differentiation that you will see between these two schemes. Besides that, going ahead, we expect financials to do well. The large, good companies will recover faster and deliver much better than a smaller financial name which is being hit by both crisis of confidence as well as the cost of liquidity, because they have not benefited that much from the low interest rate scenarios as what a larger company would have. So our focus currently is to investing into leaders or among the top three players in respective segment in the financial space. It could be banking, it could be insurance, it could be broking, it could be distribution. So across the financial sector, this is what our clear focus is. We expect IT companies to continue to do well. The digital trend, the cloud trend that we are seeing is a multi-layer trend. The IT spending is bound to increase, and obviously Indian companies are very well placed in their strategy here, and they are clear winners and beneficiaries here. So this segment is expected to do well for us. Uh, we would also look into sectors like textiles, chemicals, sectors that is benefiting from the global trade, the China plus one strategy, which India is a natural beneficiary. There are lots of opportunities that will be coming in this space, and that is something that we would like to focus on, and that will throw in lots of opportunities. We feel digital theme is, which is currently ongoing in the market, is here to stay. Anything that is online, which is digital, which benefits out of this is going to be rewarded by the markets, and that is always going to be a focus area. So these are some few sectors that we are currently focusing upon and positive on.
Thank you, Aman. Thank you for your insightful overall presentation. This has been I feel we have covered most of the concerns, as well as how we can navigate across for next 2 3 years in ongoing market. Uh, uh, Thank you everyone. Thank you everyone for coming here. We hope we try to address the concern largely and give you a scenario in a transparent manner. And in coming few days, my team, because most of you may have come late during the presentation, I would request my team also to reach out to them and communicate the message and communicate overall view of the market, what Aman has to share over these next few days. And also the feedback, we would like to come back to our attendees to take the feedbacks also. Our Wealthzi team is all time available to address the concern and the servicing of any of the products in the market. Once again, a big thanks to each one of attendees, guests, Aman, and all of our clients. Thank you, team.
Sure. Thanks everyone for taking the time out and joining us. Any queries, anything, feel free to speak to my colleagues at Abacus or at Wealthzi, and we'll be happy to help. Thanks again. Thank you everyone.